answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hansen and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hansen and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hansen.
I'm Pat McClain.
Glad you are joining us today as we talk about financial matters and kind of in the middle of summer right now. The first part, I think July 4th always feels like summer is really rolling, which is coming up this week, which would be... No?
Is that how it works?
For me, no.
Is it? It's more dependent upon the weather for me. Like when it gets really hot, the Sacramento Valley. It's like, this is summer. This is summer.
Anyway.
But that's my indicator.
Okay. But we are here talking about financial matters and helping you make wise choices with your money. And, of course, as always, we got a great program lined up. And one of the things we're going to talk about, that might not sound too exciting, but how the onset of Alzheimer's,
or not just
or dementia,
or any sort of cognitive impairment,
which could be caused by medication. I remember I had a client who was always a do-it-yourselfer. Went on a medication, and his doctor said, do not make any major financial decisions now you're on this medication.
Yeah,
so it's really hard for him.
We're going to talk a little bit about that and how to safeguard yourself or your parents or your loved ones, because we see a lot of it. I mean, we put alerts on certain accounts in our firm.
Oh, yeah.
Because we're worried about the particular clients and the financial decisions they make. Where it actually, any one time they talk to someone in the firm, it actually alerts that says, hey, either scam alert or someone's family members at the money or the client themselves probably needs some counseling about what they're doing with the money.
Yeah.
So we're going to talk a little bit about that.
And, of course, we'll take your calls. And if you want to join us, 833-99-WORTH is the number. Again, 833-99-WORTH. That will get you on
the air.
Yeah. And why don't we start right off with calls today? We're going to talk with Tom. Tom, you've got Scott Hansen and Pat McClain of Allworth's Money Matters. How can we help you?
Thanks. Glad to be here.
Thank you, Tom. Thanks for joining us.
My question regards Social Security. I have a pension through my employer of Cincinnati, and I'm going to be a victim of the windfall elimination program.
Mm-hmm.
And I'm wondering if you guys have heard any kind of bills being introduced to eliminate that, or if you think that is a possibility at all.
I haven't heard it, and I would doubt that they would. They might. When you say the word eliminate it, I doubt they would eliminate it, although they may actually trim it around the edges. So for the rest of the listeners, especially there in Cincinnati, where we actually have an office, the windfall elimination provision actually applies oftentimes to teachers and sometimes railroad workers, and
government employees that don't participate in Social Security.
For some government employees.
That's right. Yeah.
So what it does is it actually limits the amount of Social Security benefit that one could receive.
Is your hope, Tom, that there's going to be some change in the legislation that's going to increase your benefit?
I would sure hope so. That's money that I earned, and it was taken away from me, and it's for my retirement, and I'm going to probably collect about 2/3 of it, and to me, it's basically almost like theft, taking money that was taken out of my check for me. And, somebody, is taking the liberties to distribute part of my money where I don't want it to go.
Wait. What you just described sounds a lot like taxation.
Unfortunately.
Confiscating.
You call it confiscating, taking the money and putting it in places that's
what it feels like.
some places
I hear you.
where I didn't want it to go.
So we actually follow legislation quite a bit when it pertains to retirement income issues and retirement planning issues and taxes around those things. I have not I've been doing this almost 30 years. I have not in 30 years seen anything introduced in legislation that would change that.
And I would not, in your financial planning, in the process for your financial planning for retirement, I would not put any sort of caveats in there that it's going to change.
Yeah.
So when you do
I'm
this,
not
just
counting on it.
accept it as for what it is. Tom, is taxation. And if someone out there wants to tell me that Social Security isn't a form of taxation, I will argue with them all day long. It is a form of taxation. It is a safety net. Well, the dollars you paid in are not equally paid out. That's just the fact of the matter.
No, and most high income earners today going into in the past it was different. Going into retirement today, most people are not going to get a good return on their money that was put in.
That's correct.
The lower income people, yes,
Great.
more than.
Yeah,
It
but I'd
drives
rather
me
get
crazy, too. They call that an entitlement.
Well,
Drives me crazy.
I quite
Because
frankly,
you're not entitled to it. That's why it drives you crazy, right, Tom?
Exactly.
I hear you.
but I would much rather
my money.
I would much rather accept a lower rate of return on my Social Security than making less money. Those are the alternatives. If you want a higher rate of return on Social Security, then you have to make less money in retirement.
Mm-hmm.
Okay.
Right.
One other quick question
Go
I
for it.
had is I'm a divorced male in my mid-50s, and from what I understand, my ex-wife, whatever her Social Security is, if it would be higher than mine, I'm eligible for hers. And if that is correct, how do you go about finding that out?
So you could be if assuming you don't remarry by that point, you could be entitled to a spousal benefit, which would be 50% of her benefit. So either your benefit,
okay.
So
It's not her benefit.
unfortunately, Tom, you called hoping for a couple good answers on Social Security, and you got nothing.
I got a big zero.
Yeah, sorry. So I mean, the key really, particularly in your mid 50s, is to plan for what your estimate is. On the and you've got the windfall elimination provision, which I don't know why they call it a windfall, because I'm certainly doesn't feel like a windfall to you.
It's the opposite.
It feels like theft to you. But the ideal is to plan with what reality is and not what you might hope would happen. So I appreciate the call very much, Tom. And it'll be interesting. There clearly will be some changes in Social Security. I don't think it's going to be for the better of most retirees. I guess.
Yes. It will only the changes will be
just look at the math.
Yeah, it won't necessarily. It's just to keep it stable or in place.
Yeah.
I don't know if the word stable is the right word. In place.
Yeah. It's not going away.
No, it will not go away.
No way.
Yeah, Social
For most
Security
people.
is not going to go away.
No.
The benefits for some people will absolutely go away.
Or could be reduced in the future.
Okay, could be.
Your point is here
if I was retiring and my income was going to be over $125,000, just draw a line in the sand. I wouldn't be counting on any of the Social Security benefit for going forward.
I read an article. Where did I see this? It was this week. It said that the average income for a 66-year-old couple was retired was $89,000, and they didn't back up their source. I'm like,
what?
Where are you living? I mean, clearly certain neighborhoods, and maybe the type of people who hire financial advisors, but not across the
not the average.
That's what I'm like. Fake, I guess it was fake news.
I don't.
whatever
that is, whatever that means.
Yeah,
have you ever thought about how news reports fake news? Is that really news?
That would probably not be news.
There we go.
Yeah, all right, thank you. That would, in and of itself.
Correct. We could go in circles all day long.
And now let's go with Ed. Ed, you're with Allworth's Money Matters.
Good afternoon, or I guess it would be good morning for you folks calling from the East Coast. How are you today?
Good. How you doing?
Good. Got about $100,000 in Roths, and we have about $800,000 split across a variety of IRAs, 401ks, 403bs. And within one of those 401ks, I've got 80,000 in an ESOP with a cost basis of about, I don't know, $5,000-$6,000. And I guess the question is, I've heard about net unrealized appreciation.
Yep.
And do I do that now, or do I do that when I retire? I'm 60. I'll probably be retiring in 6 or 7 years. Do I exercise that now, or do I wait till I'm, in retirement and start to draw down on those funds?
Is the company paying a dividend?
Yes. Do I mention the company?
It doesn't matter, but
UTC. So I'm sure you've heard of them, and they're getting ready to split up too, which is another reason. Supposedly they're going to be breaking the company up into 3 next year, and from what I understand, there's going to be some upside when the company breaks up into 3 more companies.
Because you're over 59 and a half and still working, you do have the legal, from tax standpoint, ability to take the stock. And for you out there that wonder what the heck's net unrealized appreciation, either in a 401k or an ESOP, instead of rolling those dollars over into an IRA, which is an option, if you just receive the stock, Ed would be taxed on his cost basis, $5,000. And the $75,000 gain wouldn't be realized until at some point in the future when he sold the stock, at which point it'd be a long-term capital gain. Unfortunately, if you end up passing away, that gain is not forgiven as a stepped-up basis like other assets. But other than that, it's a beautiful strategy.
And you hold the shares, not units. So some 401ks will actually show.
Yeah,
will show it has to be in shares, not units.
Will your employer allow you to take the distribution now?
It's my former employer.
Oh,
yeah,
easy,
I would,
easy,
for sure.
Easy. Yeah,
okay.
And so it kind of depends on what your income is for the year, but that's such a small number anyway. I would do it now.
I would too.
We're probably in the 22, or is it the 24% tax bracket?
Yeah, but it's only 5,000 is your basis. Yeah,
right, it's only $5,000.
So I would do it now. I wouldn't even wait.
I would too.
Right now.
Okay.
I'd start on it next week.
And sometimes what we found is the plan administrators. You talk to someone, and it could be administered by someone who's answering 401k calls all the time, and they don't even know what you're talking about. And so,
expect it to go.
Yeah, they seem to know when I call them. They seem to have some idea what I was talking about. But I think I'll still seek professional advice. Yeah, because
I can't tell you how many times we've had to coach. I mean, I've done conference calls with 401k administrators because they don't know what they're talking about.
Expect it to go badly.
Yeah.
Truly, expect it to go poorly. We've done this a number of times. And we tell the clients from the beginning, this is why we're doing it, but expect this to go poorly, and it's not our fault. It's the administrators because we want to prep the clients.
But ESOPs are different than the 401k.
That's true.
But this works with 401k as well.
So. Right. Like I say, it's an ESOP within a 401k is the way I understand it.
Okay, do it tomorrow.
That's a great strategy.
Okay, so since your first question was pretty good, your second question.
Okay. Given where we are, I'm 60. My young bride is 57 3/4. Like I say, we're in the 22 or 24% tax bracket. Does it make sense to transfer or switch more money to our Roth? Right now, we got about 100 in Roth, about 800 in.
What state are you in?
We're in the low tax state of Connecticut. That's a joke.
Oh, yeah. I would not.
Yeah, don't do it.
Yeah.
Are you going to leave Connecticut like everyone else?
You have to move to Florida when you retire, don't you?
Our children won't let us, so we're going to stay in Connecticut. So, yeah. So
you think Connecticut taxes are going up or down?
They're going up. There's no.
Well, you want to talk about it's really been Connecticut has been a fascinating state to watch because they used to have low income taxes, and then they had all these
no income tax. We had no income tax.
Yeah, and they attracted
a lot of the hedge funds, private equity firms, right?
Yep.
And now they're one of the highest tax states, and all those people leaving. I've heard about, and you know better than I had, but neighborhoods where home values are dropping like a rock because people are leaving
around the Ridgefield area and correct. They're just imploding.
Greenwich, that area.
And Greenwich, which is right next to Ridgefield. They're just imploding. These multi.
Yeah.
You know what the problem with Connecticut, though, is, Ed?
Too many trees.
Too many trees.
No,
Too many trees.
Love our trees.
Too many trees.
You know, I was back there in Ridgefield. We're driving down the road. On both sides, nothing but trees.
Actually, Connecticut's very beautiful.
You couldn't see anything but trees.
That's the one thing we like about the state.
So no on the Roth. And your third question is?
Pension, Social Security is going to be about, I don't know, 85, 90 a year. When you're doing your retirement portfolio, your breakdown of equities versus fixed, do you regard that 85, 90 as, your fixed income portion? Does that make any sense?
Here's what you're talking about. You're talking about a rational view along with human emotions.
Mm-hmm.
So for textbook, from a rational standpoint, we could certainly say your pension is 100% fixed. Let's view this let's figure out what the net present value of that is. Let's view this as a bond portfolio. And it might lead you to say, because this is fixed income, I'm going to be 100% in stocks in the rest of my portfolio. Then what happens is when reality hits and the markets are going south and you're watching your portfolio decline, you're thinking, holy crud, my life savings is dwindling away here.
And you have a tendency to forget that idea that your pension is part of your fixed income.
Right.
So
it's up to you.
Yeah.
It's up to you.
Yeah. But at least, I guess, somewhat regarding it as part of your
you certainly could. There's
income, if not to the dollar.
So Ed, this is the conversation we have with clients. If those dollars, they're not needed for their lifestyle in any way, shape, or fashion. So we have clients that have so much money, so much income coming in that we tell them, look, you can have 100% of it in cash or you can have 100% of it in equity.
Your choice.
Your choice, because it doesn't matter.
It's not going to be for your life. It'll be someone else's.
Right,
It'll be for someone else's life because your fixed income is X. So normally we just split the difference.
Yep.
We just split the difference.
Yeah, that sounds about. I mean, that's kind of where I'm leaning. When retirement, maybe a 70-30 or 60-40.
It really comes down to what. I mean, and it depends if you're living off those dollars.
Not so, not so much. I think we could probably get by on the 85 or 90.
And you might say, you know what? Let's peel off X dollars in one IRA, and let's view these dollars as money when we're 90 years old. Or money that's probably going to go to the kids unless we both get really sick or something, right? And then you say, I've got a really long-term perspective. I don't even need to worry about that. I'm going to ignore when the markets go south, realizing that look, if you go to there's never been a 20-year period where stocks have not outperformed bonds.
Right.
And if you look at a 15-year period, you have a 99.9% chance of a positive return based on history. So looking at those odds, one could certainly argue that you should have more weighted towards equities, but it comes down to what do you need income-wise, number one. Number two, what are you comfortable with? So I think you're looking at things the right way.
So appreciate the call.
Hey, thank you.
Yeah, you're in great shape.
Bye-bye.
Thanks, Ed. All right, Pat, rather than we'll take some more calls in the second segment here, but we talked at the beginning of the program on Alzheimer's.
And even my own father, who was in a nursing home before he died, and was in and out of a number of different ones because he actually would start to get a little bit better, and we would move him home with a caretaker, into his home with a caretaker. And then...
How many homes was he in?
5. No. Some as little as a week, and some for months at a time. And he finally ended up at this board and care, which was a great place for him. Board and care is a small residential facility versus a large one. But at one of these facilities, someone got a hold of his. There's this fight where you want them to have some reasonable feeling of self-control. So I left his wallet with him. And then one of those, someone got into his wallet and took his ATM and got his PIN, which I wasn't worried about it because I'm like, they'd have to have the PIN number to get to the ATM. And they went around Northern California and took money out of his.
How'd they get his PIN?
I think he gave it to him.
Yeah.
I think he gave it to him. And I don't know, I have no idea what was going on there. I don't know if it was someone that worked at the facility or whether it was an old friend of his or whatever. At one point in time, someone got a hold of one of his credit cards and went and used it around town.
So you would not recommend leaving the wallet with someone?
I would not recommend. And it happened, and we didn't know he had any cognitive impairment when it took place.
Well, I mean, sometimes even the medication when you're at that stage can cause some of these issues.
Or just a bad day.
But I remember talking with a gentleman whose father had paid for long-term care insurance for it was like 10 or 12 years. Came down with Alzheimer's. He was still on his own, living independently, and decided to quit making his premium payments on his long-term care insurance.
Just
For whatever reason, just stopped paying them after 10 or 12 years. Not a couple months, but 10 or 12 years.
when he probably needed the coverage the most.
The insurance company canceled him because the policy lapsed.
Because he quit making premium payments.
And I don't know what the outcomes. Last I talked to the individual, he was fighting with the insurance company. And
this is a study that has come out from, it includes Duke Health and Duke University School of Medicine, which is this misperception that financial difficulties occur only in the late stages of dementia. In fact, financial difficulties or the difficulty in one's managing their own money or resources oftentimes will present itself early in an Alzheimer's cycle. So,
as you said, you didn't know your dad had any cognitive impairment.
didn't know. And in fact, after the fact, we never knew. I don't know if he was involved in it or not,
yeah, okay.
right?
Some scam.
You don't know.
Because he had so much money in his bank account.
Well, yeah. Well, fortunately, we limited the amount of money that was kept in his account for reasons such as this, and the fact that there wasn't a ton of money. So there were two reasons it was limited.
One, he didn't have much. That was an easy one.
That was the easy part. So there's something called preclinical stages of dementia, which is when the sufferer of Alzheimer's or dementia, it can happen in both those situations, will actually start to show some loss of financial abilities early on in the disease. So how do you protect against this, right? It's your children, if you're the child of someone, or if
Or
it's
maybe
your
you one
spouse,
day.
or maybe even you one day. You have to get people involved that you trust. You have to get them involved with someone you trust.
And the hard thing, I think the challenge is so often, our culture, we are very private on our finances.
And
People will share all kinds of other issues, very personal issues,
before they share
their finances.
Yes.
They'll share their sexual history. They'll share all kinds of stuff
before they'll
share their finances.
And so
can you imagine being at dinner with a bunch of guys and everyone's sitting there talking about their their finances and
where they talk about everything else?
I know, but they might brag on things they purchased, or if someone might brag if they hit a home run on something.
Yeah, and so my kids call that flexing. They go, that guy was flexing, when they start kind of hinting at that they're hitters or
Whatever.
They're called flexing. But
My point
to this is, it's okay to ask mom and dad if you suspect that you actually get copies of their or their checking account or their bank statements, or you get copies of their bills. Most certainly, brokerage firms and firms like ourselves can CC someone else, or you could get passcodes to your parents' financial and taking over bill paying. Yes. The issue arises between siblings themselves, which is the mistrust between siblings. We've seen this dozens and dozens of times, where one says, I'm going to take over mom's finances, and the other one says, well, what's in it for you? And the other is with the parents, the ability to let you do that.
And there are independent trustees you can hire for something like this.
And I recommended that to a family recently where there were 3 children and there's a lot of finger pointing. And I said, no one trusts each other around you guys. And mom has plenty of money. Why don't we hire an independent trustee that will do all the bill paying and make sure that the dollars are taken care of? And if mom can agree on it, everyone's fine.
And
unfortunately, they passed the person passed away before they got there.
Oh.
But it was the solution. It was a solution because those kids were fighting. That was some serious fighting, and it's not unusual to see that.
No. And make sure that there's safeguards in place. You mentioned, Pat, not having too much money in one particular account. If you're dealing, if you've got, let's say you've got a parent that is had the same financial advisor with the same firm for years, feel free to reach out to that firm directly.
Oh, talk to them.
Yeah, we've had those conversations.
Or ask for a POA if mom or dad are comfortable giving you a power of attorney on the account.
Yeah, so you can.
Help.
But you'll want to at least make sure that, and most good financial firms kind of keep an eye out for this sort of thing. What we do when there's suddenly a change in spending for a senior person, like
what's happening here, or there's an we had one where someone called up and wanted $50,000 because we asked why, and they had thought they had won a large lottery and had to pay the taxes first.
Oh my!
So.
All right, this is depressing. Anyway, we're going to take a quick break. We'll come back. We'll continue with some more calls. This is Allworth's Money Matters with Scott Hansen and Pat McClain. We'll be right back.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast. Do you have a financial question that needs answering? Call us at 833-99-WORTH. That's 833-99-WORTH.
Welcome back to Allworth's Money Matters. Allworth, of course, is formerly Hansen McClain. Allworth Money Matters with Scott Hansen and Pat McClain. To join our program, if you want to call, 833-99-WORTH is the contact number, 833-99-WORTH. And let's hit some phones here. We're going to talk with Scott. Scott, you're with Allworth's Money Matters.
Thank you so much for taking my call. My ultimate question is going to be, should I continue to invest in my 401k Roth, or should I just be investing in a regular 401k? But before I get there, I'd like to thank both of you, because to the age of 45, I'd worked in private industry, and then I eventually started a job with the state. And during my beginning time with the state, I would sit there on Saturday mornings and listen to you guys. And every time the buying airtime would come up, you guys would say, if I had a chance to buy airtime, I would also buy it. So when my opportunity after my 5 years with the state came up, I did go ahead and buy my airtime, which will always be grateful to both of you for always telling people to do it if they had the opportunity.
Well, thanks, Scott. And Scott, so it wasn't hard to predict that they were going to stop the sale of airtime at some point in time, just because it was so burdensome on the pension.
Yeah, and for the rest of you that don't work for the state, there was a time when you can buy 5 additional years of pension, and essentially you shift the risk from yourself to the state of California, and the rate of return was somewhere between 7.5% and 8.5% guaranteed, with a cost of living adjustment.
Yes,
and so it's kind of a
when you can buy it early, you buy it at the lower salary rate.
Correct.
So that you increase your salary, it even becomes a better bargain.
Yep, Scott, and thank you, and at the same time, darn you, because you caused my taxes to go up.
Actually, the other evening, I was having dinner. It was a large group dinner, and I was talking to a gentleman across the way that he had a break in service when he was young. He had worked for the state or some municipality that participated in PERS, took his money out, and now he was looking at buying it back in because he could buy 4.5 years, and I like begging him to. Same kind of conversation we had with you. So
thank you for that. So let's get to your Roth versus non-Roth 401k.
So I'm currently 56. I'm probably one of your low-income people. I listen to people talk about, what am I going to do with my $500,000 or $1 million? And I'm like, oh, that's not me. Anyway, so I have 11 and a half years in. I'm shooting for 20. I have my 401k from when I worked in private industry. I did make a huge mistake during the recession and invested in something I shouldn't have, so I'm left with $60,000 left of that. To pay for my my airtime, I just used what I had saved during the 5 years through the state Savings Plus,
Great.
and then I paid it off as quickly as possible
Great.
over a 2-year period, so I wouldn't be paying 7.5% for a really long time. So I have the 60,000 it's sitting in a regular 401k, and then when I restarted my savings again, for retirement, I just put it into a Roth because I thought, I need to balance these out so that when the time comes, I have a place. But I was thinking, when I retire, when I hit the 20 years at 65 or 66, I'm going to go ahead and my pension will be $3,000 a month gross, so that'll be $36,000 a year. So I'm not going to have I'm not going to be like in some super high tax bracket where I'm having to take distribution. So I just didn't know.
What's your family income now? First of all, are you single or married?
I'm single, and I currently take home about $2,300 a month, and I live comfortably on that because I'm frugal.
What's your
I'm
gross?
Not a miser, but I am frugal. Pardon me?
What's your gross income?
My gross income is this year will be $50K.
I think do you plan on staying in California when you retire?
I haven't made that decision at this point. It's still down the road.
And how much do you have in Roth today?
I want to say it's about $15,000.
And do you own a home?
I have a townhouse that I have no debt. I've completely paid off.
And you say that you have $60,000 in an IRA that was from your previous employer. Is that correct?
Correct. Yes.
I think
I would.
That's a hard one. You wouldn't?
No. The chances of do you know where would you move if you were going to move out of state?
Yeah, I don't know.
And why? Why would you move?
Why would I move? Because I've been to other states, like I visited Indiana, and I've seen the way that people, when they get old and they go into nursing homes, how it's a small town and people actually know people versus California, where you're put into a mill. You know what I mean?
Yeah.
Where people really don't care about the people that they're taking care of.
Well, the people that, yeah.
If you think you might leave California, I would use the pre-tax.
Yeah, I would probably
because
not use the Roth.
California, both federal and state income taxes for most states are progressive, meaning if you have very low income, you pay very little in taxes. The more income you make, the higher percentage. California is highly progressive, but it ramps up to 9.3%. I don't remember what it is.
Pretty fast.
But pretty fast. So you're paying a pretty good chunk. And if you switch to the Roth 401k, your California income tax would go up quite a bit. I'd stick with the traditional if I were you.
I would as well.
So I should stop contributing to the Roth at this point?
That's correct.
Well, if you're going to do that, then increase what you're contributing to your. So right now,
yeah. So if you're putting
I'm currently doing 10%.
Okay, put in 13% into the deductible IRA or deductible 401k.
Okay.
And then I got a question.
That should be about the same.
I got a question for you. You said you invested in something going into the recession that you shouldn't have. What was it? No one knows who you are, by the way.
And I always listen to you guys, always about diversifying, and I had invested in the silver stock.
Got it. Silver ETF.
So my 60,000 went up to 200,000, and then it was probably about 80,000, and went up to 200,000, and then very quickly went back to 60,000.
And was it sold to you by someone, or did you?
No, it was a family member who thought the economy was going to crash, and I would have nothing left.
Oh, got it. So anyway, thank you for taking some of our advice over the years.
Well, look. The reality is, when things are going south, and when we're in a tough time, and it was a rough recession last time, sometimes our rational thoughts are thrown out the window, and our emotions take over.
I
agree. I mean, that just goes through my mind all the time, hearing you guys always say that.
Well, and it's going to happen again in your lifetime, right? There'll be some down times again and scary times again.
Scott, I have been married to my wife, who is an accountant by education, very, very smart person, understands this stuff. But I remember during the market, there was a list of some of our holdings, and she wanted me to look at them to see if we should continue to own them. And you know what I did? I bought more. of the things that she was unhappy with. Because
That's when she left you.
well, no, that would have been a. But the point being is that there's logic and there's emotion.
Right.
And
Yeah.
and
At that time everyone was talking about the debt bomb blowing up and the currency falling to nothing.
So right. They say that the only bad mistake is one that you forget and repeat again. So, right.
Yeah.
So I think the key here is when the next time there's a horrible economy, the stock market's off 30, 40%. It'll happen again. We don't know when. It'll happen again. Just remember back to that. Remember how you felt at that time, and then remember it recovered, because the United States economy has always recovered and moved forward.
And if it didn't recover, what good is the silver going to do for you? Especially this stock.
It was supposed to go up in value.
I understand, but if there's
run to.
but the idea that gold and silver is a store of wealth is such an archaic concept.
And if you're going to hold silver or gold,
Don't hold it in a traded account. Hold it at home.
and hold it next to your guns. Have plenty of guns and
your-
ammunition.
and your food and your water.
Because if it gets that bad,
Because if it's that bad, no one's going to eat gold or silver. You can't eat it.
well, you could trade it for food.
Well, what? But other people want food.
I know.
The food is the
understand.
food.
If it's that bad, you hope you're young and strong.
Yes, correct.
With lots of weapons.
Yeah.
I guess. I don't know. Well,
Yeah.
Anyway, appreciate the call, Scott, and thanks for being
I guess everything's
a long-time
degrees,
listener.
isn't it?
Degrees?
Yeah.
But the key, it is good. It's good to remember. It's good to lose money before you're at retirement age.
Oh yeah.
As an investor.
Oh yeah. The earlier the better.
And I got to tell you, I'll be real frank. As a financial advisor, when somebody comes in and they had inherited some money or lottery winning or somehow sudden cash, and they've never had they've really never had a 401k or never really saved, never had any losses. They're really challenging to bring on as clients because they've never experienced ups and downs in portfolios. And if anytime you move out of CDs or a savings account, you're going to have fluctuation in value. That's just how.
Yes.
I don't care what you invest in. There's going to be fluctuations in value. And if you haven't had those experiences, it's pretty challenging. And the key, I think, is to learn from those experiences, what actually transpired and how did you react to them. It's usually our reaction and how the steps we take at that point are the ones that cause us the most damage.
Assuming that you have a well-diversified portfolio to begin with.
We didn't make poor choices on the way up. And we're going to continue on. Again, to join the program, 833-99-WORTH. We're talking with Jamie. Hi, Jamie. You're with Allworth's Money Matters.
So the scenario is I'm going to be retiring on July the 5th of this year. I'm 62 years old. And my husband is 67, and he's already retired last year. And the company is offering the monthly payment would be $6,000 a month, and the lump sum is $1.178 million. And I'm not sure what to do. My other financials are joint between my husband and myself. We have $2.6 million in 401k. We have $500,000 in cash. Our house is mortgage free. My husband gets between pension and Social Security $3,700 a month. So my question is, what is the best option for me, lump sum or monthly payment?
What do you think you should do?
I don't know.
Okay.
I have no idea
Right.
what to do. And I know a lot of my friends have taken the lump sums from the same company, and everybody sort of take it and take your money and run.
So the younger you are, the easier that is to. Well, which company is it?
It's a large HMO. It's Kaiser.
Okay. And the reason I ask is because the pensions have a guarantee, but the guarantee on it's not $6,000 a month from the Pension Benefit Guarantee Corporation. So if you were retiring from a company that had huge pension obligations and we're concerned that it was going to be a viable company, then you'd like get the money out of there in case the company goes into bankruptcy and you'd have a degradation on your pension. That's not the case.
That's not the case here. So do you believe you have a normal life expectancy?
Yes, I do.
So part of the challenge is
And my husband too.
the younger you are, the more attractive the lump sum is, because think of it this way. Kaiser looks at it like, all right, we've got 1.1, let's call it $1.2 million in this bucket of money, and we're going to pay out Jamie $6,000 a month until her normal life expectancy. That's how they've kind of calculated it. If you die young before that, they say, oh, isn't this great? We've got money left over. If you live longer, then they're going to have to dole out more money. How most people view this, though, however, is they say, if I have $1.2 million, I need to generate $6,000 a month. I want to maintain my principal, because what if I lived to 95? Right? I don't want to spend this thing down to zero by the time my normal life expectancy. So if most good financial planning says we need to somehow calculate this so that we've got a reasonable chance that our principal is going to remain intact. And so then, so the younger we are, the more years the company has to play with, the larger the lump sum is relative to the monthly pension. And the older we get, particularly once we're at 58, 60, 62, as we start getting older, it makes it a little more challenging to maintain the principal and provide that monthly income.
So Jamie, between you and your husband, and you'll be eligible for Social Security as well. Is that correct?
Yes.
Okay.
Yes. I'll take it at full retirement age, 66 and a half.
And how much will that be a month? Do you know?
Well, the projection, it's close to 29 something.
Okay. So you and your husband, will you be able to live comfortably on $12,500 a month?
Oh, yeah, that's more than enough.
Okay. So Scott's calculated what the
would you take a survivor benefit on this?
Which means that if you were to pass away, there'd be a portion of those dollars would go to your husband. And what would the monthly be for the survivor benefit? The full survivor, which means
the same. I quoted the survivor one.
Okay.
So 6,000 a piece. Yeah.
Okay. All right. So
if in order to maintain your principal based upon these numbers, you need to earn about 6.1%.
Mm-hmm.
Is that realistic over the next 30 years with a well-diversified portfolio? Yeah, probably.
Yeah, but
on a year-by-year basis?
No.
Anyone's guess.
No.
So, and obviously you've been investing, you and your husband have been investing for a long time because you have $2.6 million in your 401k. How are those dollars in your 401k invested? Are they in stocks or bonds or a combination of the two, or do you know?
A combination of the two. We have they call financial engines within within Fidelity that we have with our company, and they're kind of managing it. So it's a mixture based on our age.
And did you use the balanced portfolio or the growth in income or the growth? Do you recall?
Balanced.
Okay.
Balanced. And
this $500,000 in cash. So these are all, we're trying to diagnose kind of the situation. These $500,000 that you have in cash, how did that cash come to you? Did you inherit it or did you save it or?
No, saved it.
Okay. And do you have a brokerage account or stock account or mutual funds anywhere outside of your 401k?
Yeah, the brokerage account.
It's the $500,000.
Okay.
The $500,000 and just
so
like
here's
maybe $30,000.
One can make an argument either way. And if it were me at 62, if I were in this situation, I would take the lump sum. But I'm also a professional financial advisor with almost 3 decades experience. So I'm not. If you are my sister, I would probably tell you to take the monthly for 2 reasons. Number one, earning 6.1% is not the easiest thing to do over the long term. You have to be very disciplined in the markets. Number two, you already have quite a bit in tax-deferred accounts that are going to have required minimum distributions. But the third, and maybe as strong, is my guess is you've accumulated these dollars because you've been quite thrifty over the years. And my guess would be that if you took the lump sum,
You
would
won't spend it.
You're going to be thrifty until age 70, and then you're going to have required minimum distributions that are going to make things, and you won't spend it.
You won't spend it. So,
Yeah, I'm not a spender, that's for sure.
although you didn't need to tell us that.
Yeah, that's why you have the money, right?
So I'm inclined to go with Scott, and partially part of it being is that the 12,500. So if you're listening, where did they come up with the 12,500? So if you're taking $6,000 a month, and then you've got $2,600 in Social Security that's going to kick in at age 66, which is 4 years, and then we've got almost $3,700 a month for your husband. You round it up, it's $12,500 a month at age 66.
I would not. I don't think I'd take a joint 100% survivor benefit though.
Why wouldn't you?
Because she's 62, he's 67. They have no debt on the house.
Really?
Oh.
Well, just from a mortality standpoint, if she wants to protect some, that's probably better off buying term insurance for a period of time. There's a 5-year difference in age there.
I'd have to crunch the numbers. I don't.
I don't know.
You say it confidently, Scott. So,
Well, there's not a huge difference, actually.
how big is the difference?
You're only talking about $100, $150, or $200. So, to me, that's just
Okay.
not
Well,
worth it.
usually
There's normally
there's several options. Usually.
Yeah. I question whether that it's just the $100 or $200 a month because it would normally be quite a bit more than that.
In any case,
So it's just from what we know about you so far, which is two guys on a radio show that you've never met. You called and asked about your money.
But it is good because the one nice thing with Jamie knows we're not trying to sell anything.
Yeah,
Right?
I don't have a dog in this fight. I would be inclined to have you take the monthly pension. I agree with Scott.
And you know what? Everyone's situation's different. So if your other financial situation wasn't like this and other things going on, we might tell you to take the lump sum. If you were 55, we'd probably tell you to take the lump sum, just because the lump sum would be larger. Because you'd be younger and more years that the company has to figure to pay it out. So just because your coworkers are doing one thing doesn't mean it's the right thing for you. And by the way, most of your coworkers
don't have this kind of money.
Nope.
Yeah. But they probably drive a nicer car.
No, they do. We're all about the same. But so I should take the monthly payment because I'm still trying to figure out.
Because it gets you to your objective.
It's a think of it this way. Okay. It's a 6.1% guaranteed income.
Yes.
And you already have a substantial amount in non-guaranteed assets, or at least some. But when we get a time when the 10-year government bond is paying roughly 2%, to get 6%,
it's not an easy number.
Not without some risk. So.
Especially with the market right now, taking that money and investing in when the market is right at the top.
Well, we don't know whether it's at the top now or not. We know it's a new high.
If you think about it this way, you've got $3 million in savings. You've got $1 million in your pension. By taking the pension, you're roughly saying, I'm taking 25% of my assets and guaranteeing a lifetime income with that.
That's all you're doing.
At a 6.1%. I think it makes sense for you.
Yeah. And you were
like that three-legged stool kind of a thing, you know. Got Social Security, you got pension, and you've got your 401k, which is invested in the market.
Yep.
Correct. Either which way, and
I have a feeling next time we go through a downturn, which we will, you're going to be happy that you have a monthly income, a guaranteed income.
It's the right thing for you to do. And then just dig into the joint and survivor benefit for your husband and make that decision there. So, depending upon the cost, it just when you said it was only $100 to $200 a month, that just doesn't sound right to us.
But anyway, there's probably several different options.
Okay.
All righty.
All right. Sounds good.
All right. Thanks for calling.
Much.
Thank you. I'm glad you called. And it's always interesting because every situation is so different.
Well, what's interesting, Scott, is that she gave us we didn't have to ask her what the overall situation. She was prepared. She was prepared. She reeled it out for us. So maybe she had heard someone ask us that question previously.
Big decision.
Yeah, it's a 1.1 million.
That's a huge decision.
Yeah.
There's no question about it.
All right. Scott, this might be a little esoteric, but I found it extremely interesting.
Because you tend to find esoteric things.
Well, in the financial markets, I wonder if we're watching the same movie again, which is. This is an article I came across a while ago, a few weeks ago, that said non-banks are the largest holders of collateralized loan obligations globally. Collateralized loan obligations globally. Does that sound familiar?
Aren't all loans collateralized loans?
Not all loans are.
Okay, aren't the credit cards not?
Credit cards not.
Aren't most loans collateralized loan
Most
obligations?
loans are collateralized, but I think that the key here is that the non-banks are the largest. Because last trip around the block, it was the banks that had the CLOs, which is part of the reasons the mortgage crisis, right? So there's about $750 billion in collateralized loan obligations are outstanding globally. And 1/3 are held by the banks in the U.S., Europe, and Japan, and the rest are handled by non-banks, which are, who are they? Well, they're insurance companies. But this kind of brings me back to
pensions.
This kind of brings me back to when they were doing the stress testing for the banks, that they wanted to include some large insurance companies in the stress test because of their role in the global financial market.
There was a big fight over MetLife.
And there was a big fight over,
large political fight.
Yeah, hey, we're insurance companies, but we're not that big, so you don't really need to stress test us. We're not part of the global financial situation. And I think, well, actually you are. You're just not regulated like a bank is. And you don't want to be.
You have a different regulator. You're state regulated, not there's no national regulator like there's for the
big difference. So is this something that you look at and you say, is this affecting the bond markets? Are there so many buyers out there that it's actually degrading the value of?
As interest rates as low as they are, there's a lot of cash sloshing around looking for a place to go.
Higher yields.
Or positive yields.
Okay. And what happens? What happens?
Supply and demand.
And if you're searching for a higher yield, oftentimes you actually have to go with less
certainty, more risk.
More risk, which is what we're seeing here. Yeah. It's collateralized loan obligations. So
be careful. You go looking for the highest yielding mutual fund, for example, it might be loaded up with a bunch of stuff you know nothing about.
Especially in bonds.
Yeah, we are out of time, unfortunately. Hey, a couple things I want to let our listeners know about. One is we've got a couple other podcasts on our website at allworthfinancial.com. One is The Art of Retirement. We interview some people regarding their retirement situations. It's kind of interesting. And also our Simply Money podcast. This is a show that airs in Cincinnati with Amy Wagner and Nathan Backrad. It's a daily show. You can get both of those there. And we're out of time, so we'll see you next week, the same station. This has been Allworth Financial's Money Matters.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.